Many entrepreneurs pour all their time and energy into running their business, but forget one crucial thing: who's running their money. In today's episode, we're joined by Alexander Harmsen, CEO and founder of Global Predictions and creator of Portfolio Pilot, an AI-powered financial advisor helping over 30,000 people make smarter money moves.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
Today, we'll uncover practical ways to protect your personal finances, optimize taxes, assess risk, and future-proof your wealth so you can secure your financial future as confidently as you build your business. So Alexander, welcome to the show.
Thank you so much for having me, Candy. Happy to be here.
Thanks. I'm excited to have this conversation with you too. Looking forward to the information that we'll learn, through the chat that we're going to have. And I wanted to start first with, mentioning that sometimes business owners really don't even pay attention to their finances, but many still do pay attention. They're really looking at profit and cash flow and all of that, but then they don't really even look at their personal finances. So I'd love for you to talk about, why do you think that happens and why is that dangerous?
This is the third business that I've been involved in directly running or founding myself. And I think every small business owner knows that it feels like I'm already juggling 1,000 balls, and just for the business itself, let alone real estate and where I live, and thinking about IRAs and 401ks and self-directed this and crypto or diversification or personal finances, budgeting, retirement planning. I think it all just feels like it comes second, or it's simply just like the 1,001st ball that I'm now juggling. And so the idea of getting on top of that while I'm not even on top of my own business, I think it's crazy or overwhelming, or naturally just comes lower on the stack, right? I personally focus on just 3 things every single day for my business. And then there's 1,000 things that end up getting done, of course, but I often judge my day's level of success by whether I got the 3 most important things done in any given day. And it's rarely my personal finances that make it into that list, right? It's call this client, or follow up with this partner, or fix this thing in the software stack, or whatever the most pressing thing is on that given Tuesday.
I agree. I think a lot of times too, people feel like, well, I'm not even an expert in this area, and it's hard enough to deal with on the business side and paying attention to that. As long as I know that the business has money that's going to pay me some type of income, and I can pay my personal bills, I'm good, and I don't take the time to look at it. So, because it's like you said, it's one more thing, that has to be done, and it's not always the top of mind, because like you said, as long as you have some money in the bank, then things are generally good. So I'd love for you to then talk about, what do you see as kind of the most common and costly personal financial risks that business owners are facing outside of their company?
Yeah, if we think about personal finances, and at this point, we have something like $30 billion of assets on our platform, and over 30,000 users. We're an SEC registered fiduciary financial advisor, but it's completely automated. So basically, the AI that we have is actually generating the advice and recommendations for people, but we're not managing money. Very high level, I think we're starting to trust AI more, but we're not quite at a point in society where we can just hand over, full control to the AIs. But the idea that you could sort of add all your preferences and finances and life goals and, short-term and long-term liquidity needs, run some different scenarios, get optimization suggestions across financial planning, tax optimization, investing. I think we're ready for that, right? Even if it's simply just a second opinion. And so really that's what we've built with Portfolio Pilot. I think if I talk about the 1,000 odd, individual user conversations, client conversations I've had over the last 2.5 years, I think there's a common pattern around people just not taking advantage of a natural amount of compounding. And so there's a crazy amount of people that just are sitting on a mountain of cash. 20% of their entire net worth is simply just sitting there, in cash and a savings accounts, earning almost nothing, 0.1, 0.2%. And, even if you want that cash, if you're saving for a down payment or something like this, for most people, it's probably better to put it into a high yield money market fund, at 4%, 4.5% these days. It's one of the benefits of interest rates being high. There's not many benefits, but this is one of the benefits. Thinking about overconcentration, I think it's like a very common thing these days as well. I have lots of different accounts. My wife's 401k, and I have this IRA over here, or so my husband set up a whole bunch of 529s for the kids over here, and it turns out that because they're all invested in different funds, and everyone seems to like Nvidia these days. Actually, 12% of my total net worth is in Nvidia right now, even though I don't own a single share of Nvidia myself. Even something like that is quite possible these days, just because of all the index funds and all of the active managed funds, and there's sort of an overconcentration of these like Mag 7 companies in the market. I think there's a lot of tax optimization opportunities for people that they really, I think most people don't realize. And even when they realize it, they don't want to think about it, right? The idea of doing taxes is so brutal. I'd rather just do it once a year, March, 2 weeks before the deadline, fire up TurboTax, do my thing. But when it comes to investing, there's a natural market volatility. And so you can actually do tax loss harvesting and tax optimization throughout the year rather than just once at the end of the year. And by the time you actually get to filing your taxes, a lot of those opportunities might be gone. And then probably the last thing is that I think partly because it feels complex, partly because, they're just like, I don't know exactly what I'm going to open up, sort of a, Pandora's box situation. A lot of people don't even look at their accounts. And so it's quite often the case that people go through and set up their Portfolio Pilot account, they connect everything, and they realize, wow, I didn't know, I was paying $6,000 a year in fees, across management fees, across individual mutual fund fees. It's, 0.5% here and 1.2% here and 0.8% here, but it adds up. And if you have like any sort of reasonable size portfolio, if you have $500,000 worth of net worth, even across your, Roth and IRA and 401k accounts, 1% of that is $5,000 a year. For most people, it's actually a very meaningful amount of money that's being spent in fees every single year, without people knowing or really paying attention to that. And so simply just surfacing that for people, I think, is usually a very helpful slap in the face, that we can provide clients on day one.
Well, even when you were talking, I was thinking, if people already feel it's hard to manage their personal finances as it is, now you're getting into investments that's even more confusing, and knowing, where should I have my money, and should it be in specific stocks, or should it be in bonds, or should it be in investment accounts? Like, there's so much to know, so that gets confusing anyway, and can be one more thing that's overwhelming. But it's also I'm thinking too, when you're talking about the fees, that are being paid, I know there's the two options. Usually it's assets under management, or like when you're having trades done, you have to pay commissions. So is there a way then theoretically to avoid some of these fees that you're not paying the $5,000 a year or more, but not having to pay per transaction?
Yeah, many ways. And so, if you dig into it, do all the research and figure all these things out, there's probably an answer to almost, every single one of these things. And, it's become quite popular over the last 5 to 10 years for brokerages to offer no fee trading at all. And so at this point in 2025, if you are still calling up a broker or paying any amount of money, directly for, in commissions for executing trades, like, you're probably doing it wrong. You're probably not with the right broker fund. It's very easy to move money into, any number, any one of dozens of, no fee brokerages that offer, commissionless trading. The other part around, fee management, if you have a 401k from a previous employer, you can probably do a 401k rollover to an IRA. Very simple to do, very simple to initiate, shouldn't cost you any money to do this rollover, and lets you get out of paying the 1% fee and probably an additional, 0.8% or so per mutual fund, a fairly restrictive, universe of securities that you could be investing in within this 401k. The 401k rollover, basically, if you have a 401k, you're not actively contributing it with your current employer, they're matching it. Probably you should think seriously about a 401k rollover. This one move could save you a tremendous amount in fees. And so I think there's lots of those things, right? And, always, from the beginning of building Portfolio Pilot, our general philosophy has been, we're not going to do everything for you, but, we should be able to do 95% of the work for you, surface these recommendations, make it very easy, try to guide you through this process so you still feel in control. And, you get a lot of this transparency that, frankly, a lot of the rest of the investing world and financial services world tries to hide.
So now that someone knows, okay, well, I am facing some financial risk, I'm not, necessarily paying attention, or I'm paying too much in fees, like, how can they actually assess the risks that they are facing and determine how to manage those funds based on what they find?
So we'll give very specific recommendations. Like, we'll get as specific as, Candy, you should sell $20,000 of this mutual fund that you hold here in this account and buy this ETF instead. It's basically the same fund and the same exposure and the same companies and same asset classes, but you'll be paying, $900 less per year in fees. And so we'll give you a very specific recommendation like that. And, we're allowed to do that because we're actually a, registered fiduciary, with the SEC. And then practically, I think if you have a little bit of guidance like that, it's actually relatively easy to spend half an hour, and just, set this up or make the trade. I think the other big part of it is, it feels like relatively little today, right? But, what's 0.8%, is that really worth the headache? I could be meeting with another 5 clients, to sell them this sales tool, or, bring them into my shop, or, whatever small business, thing you got going on. But these things really compound. And so it's possible that the most helpful thing that we built, and we've actually built this relatively recently, because we focused a lot on the guidance. And then, one of the things we realized was people aren't taking the advice as seriously as we think they should be. And part of it is very psychological, right? Just like, I'll do it. Why don't I do it next month, right? It's not really going to make much of a difference. It's easy to procrastinate these things, all the balls in the air that people are juggling. And so what we decided to do is to connect it through to your long-term plan. And so there's this like core retirement planning module within the product. And, I'm talking about Portfolio Pilot, but I think it's relevant for, whether you use Portfolio Pilot or not, right? But it's this idea that, if I rebalanced my portfolio, or if I thought about overconcentration and downside protection a little bit more, and my, point score went up a little bit more, I can actually trace through where I am today, at 42, all the way through retirement, and see that this one little change today means I'll have $162,000 more in retirement. Suddenly, that small little change is way more impactful than just saving, $900 a year. And, if you do that a few times and you think about Roth conversions or 401k rollovers or fee reductions, you can change, there's all these little sliders that you can change and run these different scenarios, and run a scenario where the business does really well, run a scenario where the business doesn't do very well, run a scenario where your salary is impacted for the next 4 years before it goes back up to normal, cut through life savings, reverse mortgage on the house. I want to leave $1 million to my grandkids when I die. How likely am I to be able to hit these, sort of end of life goals for myself? Even modeling out, what happens if I get a divorce? A lot of people don't include that as part of the core plan, but, people run it as a side scenario every once in a while just to see what that impact will look like. And so the idea of doing that and running, and all of the retirement planning stuff as part of the product is sort of see the long-term impact. It's all part of the free version in the product. We made this decision pretty consciously because we said, before people can really take the advice, that they have to pay for, we want them to be fully bought into the fact that having a little bit more ownership over their own personal finances ends up having these massive, end of life ramifications.
So earlier you talked about tax loss harvesting too, and not waiting, till once a year. And some people who heard that may not even know what that means, let alone that they should be looking at it more than once. So can you talk about really what that is and how it can help them save money?
Yeah. So this has come up like a lot more often and become a lot more common over the last, say, 5 to 10 years. But like you said, it's still not very widespread at all that you could do something like this. And so the main idea here is, imagine in March, a couple months ago, I don't know if you remember this, but we had this dip in the market. Everything fell. The S&P 500 fell by something like 10 to 15% in the span of a couple weeks. Something about Trump, something about tariffs, and, changes in taxes, and basically a whole bunch of market uncertainty all at once. There was some expectation that interest rates would be cut. That decision was delayed. And so 15% drop all of a sudden. And then 3 weeks later, everything basically rebounded. And, the market basically said, we think with this guy, we're going to have a lot of uncertainty, but we basically just need to deal with it. And, there's all kinds of other stuff we should pay attention to. Tariff on, tariff off, who knows what's going to happen. Let's continue on. It's not useful to be bearish and, take risk off for the time being. We'll just plow through. And so what happened during that period, as soon as markets fell, we have something like 30,000 users, right? So our system automatically sent out thousands of emails to people telling them, you have tax loss harvesting opportunities available in your portfolio today. And basically what that means is that compared to when you bought the security, say you have a paycheck every 2 weeks and you put money into some S&P 500 fund, the S&P 500 funds that you bought from, September, October, November, December, January, February are suddenly now all underwater. And so they've lost money compared to when you bought them because this 15% dip in the market. And, the general wisdom here is hold on, things, if you don't need the money right away, then, just ride out the storm and, hopefully things get back to where they were before. You don't want to panic sell and just, get out of your positions. But what you could do is actually sell those positions when the market is down. And because you've lost money on these funds that you've bought, you actually get a tax deduction. And so obviously if you sell and you've made money on the stocks, then you have to pay taxes. The IRS likes that a lot. But if you've lost money, then you get to deduct those losses a certain amount against your income. And, the rest against any stock gains that you might have. You can also just carry forward these losses, indefinitely into the future. You don't want to just sit on cash. And so what you could do is simply just you can sell those S&P 500 funds and buy into another fund that's very similar. It's not exactly the same, but you could buy another large cap fund, for example, another ETF. Could also be passively managed, tracking some large cap index. Even if it's an index that tracks the top 400 companies instead of the top 500 companies, it's very similar, and you get to ride the wave back up when it recovers. But you've booked that tax loss, you harvest those losses, and then you can trade into something that's fairly similar, while it goes back up. And so in that moment, that opportunity only existed for 2 or 3 weeks before the markets recovered. And so if you didn't harvest those losses in that 2 or 3 weeks, then, it's quite possible that by the end of the year, those losses are gone. And so, you could have saved thousands of dollars, in this 2 or 3 week period if you were paying attention or if you got one of these alerts. And it's one of those things that, ends up being very meaningful, kind of like fees that you're paying. It's a optimization that not that many people are looking at. And it's a completely different way of making money or saving money that you otherwise would have spent. It's very different than, finding next NVIDIA, right? I think a lot of people think, I'm a good investor or not based on whether I have a good sense of stock picking or how many hours of research I can put in to find the next Tesla or Palantir, or can I track the forums and Wall Street bets? And I personally don't like any of that stuff. I don't even know if it's possible for a retail investor to do better stock picking than, all the hedge funds on Wall Street with the billions of dollars of, computer algorithms and the high frequency trading. And honestly, it feels like a fairly random bet on, this company versus the other company and whether there's some displacement or potential alpha or not. These kinds of strategies around fee minimization and tax optimization and thinking about better diversification, that feels like the kind of stuff that, regular folks like us can actually affect, can actually take advantage of. And so that's why we focused a lot more on the portfolio management side of investing, for individuals, rather than trying to promise outsized returns because we have some fancy AI algorithm that can beat the stock market. There's enough people that make claims like that I don't want to add to that noise.
Right. Well, someone might be thinking, though, hearing about selling low, now you're losing the money, and now you're reinvesting at something that's similar, that's lower, and then it's going to grow again. And they might think, yeah, well, like I'm losing, but then I'm gaining again too. So now I have capital gains in the future. So I've tax loss this year, great, but now I have to pay more on the tax too. So what's the benefit in the long run, right? If I still have the capital gains that I now pay tax on too.
Yeah, I think that's extremely reasonable if you sell it at the end of the year, right? What happens for most people is that the gainers, they simply just hold on to them for a very, very long time, and then they end up selling that part of their position with low cost basis, with the low sort of entry position. They end up selling that in retirement when their overall income is relatively low. And so they end up not having to pay very much tax on that at all. Mm-hmm. The other big part of this is that there's a difference between short-term and long-term capital gains taxes. And so you could actually tax loss harvest short-term capital losses at a higher rate than long-term capital losses. And then, if you had the choice, it's much better to take the tax loss harvest, the extra tax benefit. It's much better to do that today. Mm-hmm. Simply just because the present value of that cash is much higher than some potential tax burden that you have to pay, 20 years from now, 10 years from now, even 5 years from now.
Right.
Not to mention that it can compound, as it grows.
Right.
And so typically the longer you can defer taxes, the better.
Right.
In almost all situations, that's a better move.
Yeah, right. I totally understand that too. So if someone's listening though too, and they're thinking, okay, well, I want to future-proof my wealth, right? So I understand the tax loss thing now, and holding on anything that's capital gains till later when I have less income, and hopefully my tax burden is less, but are there other things maybe they should be doing to future-proof that wealth so that the value of their investments continues to increase?
One thing that's commonly surprising to folks is that I think it's very common for people to think okay, if I'm 50, then I should have a certain amount of risk that I'm taking, maybe moderately aggressive or moderately conservative, which means that I should have 70% stocks and 30% bonds, or 50-50 stocks and bonds. Some ratio of stocks and bonds. Mm-hmm. And I think that model is largely dead at this point. And I think, for people in the space, quote unquote professionals, and, I think at this point it feels like old school wisdom to think about your portfolio simply as, the stocks as the accelerator. That's where I'm going to get all my gains, and the bonds as the brakes to, add a little bit of downside protection into the portfolio. In reality, you can get a lot more diverse than simply just stocks and bonds. There are many, many other asset classes that, individuals have access to these days. Commodities, index funds, real estate, and REITs. Even within the bond universe, there's a big difference between, inflation-linked bonds, short duration, long duration bonds, within equities and stocks. It's not just the S&P 500, but small caps and emerging markets and developed market stocks. And I think if you think about your portfolio in this much broader sense of a much larger universe of different kinds of securities I can be investing in, then suddenly you could get way more diversified than you could get if you were simply just considering stock and bond portfolio. Mm-hmm. And because you can get way more diversified, it means that for the same level of risk that you take, you can actually get way more returns. And so it's surprising to people where, typically people add their portfolio into the product. And then we tell them, here's the risk that you say you're comfortable with versus the risk that you're actually taking. Right. And first, you want that to match roughly, right? It doesn't need to be down to the decimal, in terms of volatility calculations, but should be roughly in the same range, right? You don't want to be surprised that you're taking more risk than you are comfortable with the next downside, with the next downturn.
Mm-hmm.
But it's actually quite common for people to be taking less risk than they're comfortable with. And so, people say, I'm actually willing to push the risk. Now that I have some measure of that, I'm actually a lot more comfortable, sort of pushing the risk a little bit, pushing the returns. But then we also tell people just how efficient their portfolio is. A lot of people just have a very inefficient portfolio, because they're not spread out enough. And so if they simply diversified a little bit more, their overall risk would drop, which means that the overall expected returns and risk on the individual securities could be way higher than it is in their current portfolio. Mm-hmm. And so this idea of portfolio efficiency, I think, is lost on a lot of people. And when they realize for the same level of risk, I can get higher returns, that is, like, I've seen this over and over again, some light bulb moment for folks that almost feels like free money. Mm-hmm. And so I think recognizing that you can change your portfolio construction, simply just reweighting the different items in your portfolio or adding a couple different asset classes means you could have a portfolio of high expected return securities that is also, at some reasonable level of risk.
Nice. Well, this has been very informative. I know we're coming to the end of the time that we have together today. So I wanted to ask, do you have an offer that you would like to extend to our listeners? And if they want more information, how can they connect with you?
Yeah, thanks so much for having me on. Every single week we put out a new version of the product. And so I'm always looking for feedback on Portfolio Pilot. We truly want to build an entirely new category around AI-powered financial advice, this idea of personal financial intelligence that sort of understands you and your personal situation, sort of follows you around and proactively gives you advice. That could replace an entire industry of human financial advisors with their 1% fees. If you use the promo code podcast, then you get a full month of free Portfolio Pilot Gold. Even if you simply just use our free portfolio tracker and run some scenarios within our free comprehensive retirement planning tools, or get a personal assessment and second opinion, I'd be very happy with that. Even if you get a little bit more confident about your situation, for most people it takes 5 to 10 minutes to set everything up. And so, no excuse that it will take too long and I need to really, really understand everything. And then, reach out to us at support@portfoliopilot.com or reach out to me directly at alex@portfoliopilot.com. I meet with 2 to 4 clients every single day, and I love it. Even if we have 30,000, investors across the country, it's amazing just to meet Americans, hear about their situation. And all I really want is for people to just have a little bit more money in retirement and feel a little bit more confident, taking control of their finances.
Nice. Well, thank you for being a guest on my show, Alexander. I really appreciate it. And I appreciate the insights that you were sharing today.
Thank you.
And to the listener, if you enjoyed today's topic and you want to hear additional information, you can find access to exclusive content in the show notes. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.